America's economy is motoring again. Jobs are being added at an average monthly rate of nearly 250,000. Unemployment has halved since its peak. Property values are surging, and growth is running above its trend rate. Car sales, that bellwether of American sentiment, are at their strongest pace in a decade. So will the Federal Reserve raise interest rates this year for the first time since 2006? There's no bigger question facing financial markets this year, and indeed finance ministries around the world. And yet, in recent days, the answer has become increasingly unclear. The problem is the US keeps on hitting economic speed bumps, slowing its exit from the Great Recession. The ones most vexing the Fed right now are international, namely fears of market turmoil emanating from China, which have clobbered US stocks, and the risk of a new dollar upsurge. Some Fed policy members attending meetings in Jackson Hole, Wyoming in August argued these factors should stay Janet Yellen's hand.
With inflation taking so long to get back to target, and I think that our outlook alone is an argument to consider additional accommodation. The downside risks that I think are to the global economy that are being reflected in some of the equity volatility that's taken place over the last few weeks. I think it's another argument to be very cautious about removing accommodation and potentially considering adding accommodation.
But the Federal Open Market Committee, which meets behind me to consider its next move, is a divided body. Jim Bullard, the president of the St. Louis Fed, is amongst those who are likely to be arguing for a move. To him, a Chinese slowdown should not prevent the Fed from acting.
The idea that Chinese growth is maybe slower than the official statistics is something that's been around for a long time, surely priced into markets in some way. I think the Chinese economy will continue to expand. So I don't see really anything that has happened other than a sell-off in equities globally that's really very compelling. And that sell-off, if you look at the U.S. market, which was selling at pretty high price to earnings ratios, maybe has come down to something more in the space of normal pricing for the equities. So all in all, I think the assessment will probably be that the outlook has not changed too much for the U.S. economy. The market turbulence didn't develop into something more dangerous, and therefore we can probably just go ahead with our existing strategy.
To optimists, the evidence of a thriving US economy is everywhere. Car sales are one good example. The latest statistics suggest they are selling at an annual rate of 17.7 million. Meanwhile, auto loans have surpassed the $1 trillion mark, suggesting Americans are spending and borrowing more freely.
They're up dramatically. Sales are way up from what they were in 2008 and 2009, but they were extraordinarily low in 2008 and 2009. There were people that were forced to keep cars that they should have replaced. But there's also a greater demand for cars because there's a population increase. There are over 300 million people in the country now. And we have an aging fleet. So we're doing a lot of replacement sales, which is good. That's very stable. I think apparently the volume is going to stabilize somewhere around what we're doing now, which is a good year.
What's more, hotspots are beginning to emerge that are raising financial stability questions among some people. Commercial property prices have surpassed their all-time peaks as investors are lured in by low borrowing costs and young professionals flock to city centres.
I think low interest rates are definitely increasing the demand for commercial property. People are looking for high returns. Capitalization rates have stayed pretty low in the gateway communities that Grosvenor's interested in terms of the property valuations that we're seeing and acquisitions on the multifamily side. Increase by the Fed does concern us in terms of valuations and capitalization rates going forward. However, in the gateway communities that Grosvenor's interested in, like Washington, D.C. and San Francisco, we have seen a resiliency in cap rate increases, and we think valuations will remain high for the foreseeable future.
Yet for many Americans, the benefits of a recovering economy are threadbare.
I'm an admin assistant, and I noticed that the wages are not getting higher. They did give us an increase, but the insurance went up. So I feel that the economy is doing better for the richer and is the poor are getting poorer, and even the middle class are getting drained to the poor class. And for me to be able to have a better economy and a better life, it will be to get a higher raise and the insurance to get lower.
What's more, the global turmoil is hitting many businesses. Exporters like this Baltimore-based dredge manufacturer may suffer if there's a serious emerging market slowdown and the dollar heads further north.
Any exporter wants a weaker dollar. All other things being equal, it makes their job easier. I think that our role or our goal is to be the low-cost producer of first quality equipment. So as a low-cost producer, we have some room to change our prices, which we can do and have done. We also have ways that we can adopt lean management to reduce our costs, and some of our costs have gone down as well from lower commodity prices. So I would say a dollar, all other things being equal, does affect the American exporting community, but there are ways to survive past it.
The message from Jackson Hole was that central bankers still intend to raise rates, but the timing is highly uncertain and views within the committee are mixed.
The question of whether they're right to consider raising interest rates is of huge consequences for the American recovery and for countries around the world. If the Fed acts too harshly, it risks stalling the American engine. That would risk cutting short a recovery that is easily the most promising of any major economy around the world today. For the Financial Times, this is Sam Fleming.